I'm on Instagram, and if it doesn't work anymore, that would give me maybe another 10, 20 minutes per day.
We cannot have the same sort of lockdown you see in the mainland. That's just not possible in Hong Kong.
I think there's a profound lack of appreciation for how dangerous the market is.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Market relief while global stocks climb, a sell-off in bonds abates on easing concern over monetary policy. Moscow undercuts Macron while saying no deal was reached with Vladimir Putin at a meeting Monday in Ukraine. We get the latest on that. Plus, stay with Bloomberg Surveillance Early Edition because this hour we speak with Sweden's Handelsbanken Chief Executive Karin Ackerstorm and to BlackRock's Vice Chair Philipp Hildebrand. And you can send in your questions for both of these fabulous guests on IB Plus TV Go. But first thing is first, so let's check in on the markets. And we're seeing not only easing when it comes to some of the stock markets, but also a nice lift on for technology stocks gaining some 2.4%. Overall, the European stocks gaining 1.4%. The focus, actually, if I look at the industry groups, I think they're all on the upside, apart from one that's down very, very little. The focus is, the bond market and the fact that we're seeing stabilization there, and that's giving a nice lift to some of the markets overall. The U.S. 10-year yield, I know there's a psychological level of 2%, which we could see quite quickly. The main question that we have for a lot of our guests today is, are we now seeing a bond bear market? Remember, it's very difficult to define a bear market bond because it's something that's usually attributed to stocks. But the U.S. 10-year 1.92 and then the Italian 10-year also getting a little bit of support. Now, part of the reason why we're seeing support in the markets is really what we've seen from China. Now, China's national team have said to be buying some local share in the stock market. So this is what we've seen over the last couple of years in terms of state intervention. Yesterday, I think, was one of the first times that they actually, did it whilst the market was still open. So it could have an impact on what they're thinking. Again, this is divergence. A lot of the Western world going into tightening, and of course the PBOC and some of the Chinese authorities not doing so. Now, to talk about the markets, we're joined by Geraldine Sundstrom, portfolio manager for asset allocation strategies at PIMCO. Also with us, Christine Aquino from our Markets Live team. So thank you both for joining us. Christine, let me kick off with you. I know one of the million-dollar questions that you pointed today is we need to try and figure out whether bonds are in a bear market. And it's not as simple a question as it sounds.
Absolutely, Francine. Again, as you mentioned earlier, there's not really a strict definition for a bear market when it comes to bonds. But certainly, if you have been a bond investor trying to time and ride these markets the last couple of months, it would certainly feel like a bear market, given just the speed and the levels at which we got to, especially earlier this year. And so, yeah, it really is probably feeling like that for a lot of bond investors. But it seems like, at least for today, the price action is suggesting that they're getting a bit of a breather. So perhaps that bear market feeling is abating a little bit, at least in the short term.
Yeah, so what's your take, Geraldine, on what we see actually in terms of bond bears? Are we in a bond market? And is there a psychological level about the spread? I don't know whether it's treasuries or the spread between Germany and Italy that actually makes you worry about what's ahead.
Good morning, Francine. Well, I would say that bonds now are coming to a place where, the inflation picture is getting priced, the central bank reaction function is getting priced. And really the question is, by the end of this year, how will lower growth, higher supply, and all the accumulation of global central bank hikes bring us in terms of picture? We would think that by the end of the year, chances are that the inflation picture is going to look a lot better and that things are going to calm down. The first few months of the year were always going to be very volatile.
Thank you for that. And actually, when you look at some of the volatility, what's it mean going forward, Geraldine? Can we see a bit of support, or, does it mean that the volatility will abate? Is it just teething problem because of the communication for central banks, or could we see 2022 where volatility is out of control?
I think it's going to be data dependent. Central bank have said that they have very little clue of what is going to happen. This is an unprecedented environment, and inflation data is going to be the driver. We can also look at what's going on with oil prices. We know this is a big driver of inflation and inflation expectation as well. So the next few months, there's very little that is going to reassure markets. It takes more than one data point to create a trend. So we think it's going to be really from the second quarter that markets are more likely to calm down. At the same time, there's so many hikes you can price within 1 year, and we're getting towards the maximum that is physically doable for 2022.
Christine, talk to me about the dollar a little bit. Is it decoupling again from treasuries, and what does it tell us about broader market sentiment?
Well, Francine, yeah, we're definitely seeing this resumption of the decoupling in treasuries and the dollar for certain. And I think that really speaks to two things that's currently happening in the markets. One is, of course, this idea of a potential policy mistake that the Fed may be walking into down the line. As Geraldine says, there's only so many rate hikes that markets can price before they start thinking about, how does it actually affect longer-term growth trajectory? And then the second thing, of course, is what's happening elsewhere in the world when we're seeing the ECB and the BOE catching up to this hawkishness that the Fed, in a lot of ways, has led the way in. And now we're seeing that flowing through to their respective currencies, the euro in particular, really feeling like that ECB meeting last week was quite a game changer in helping the euro really catch up to the dollar. And of course, it will be at the expense of the greenback.
Christine, also give me a sense of, some of the things that we're looking for in the earnings season is actually what it tells about the balance sheet of some of these corporates.
Absolutely, Francine. We've seen time and again in this season that any company that is able to return or give returns to investors via either buybacks or dividends are very much being rewarded. And so the flip side of that, of course, is the fact that any of these highly levered companies that have very poor cash flows are being punished as well. And we're certainly seeing extra vulnerability in that for these weak balance sheet stocks, especially when we're entering into a period of higher rates and higher yields.
Geraldine, when you look at some of the things that are out there, is the market getting ahead of themselves when it comes to ECB expectations?
It's hard to tell. There might be a desire from the ECB to get back to zero, but really looking at the fundamental picture, I would say that maybe a little bit. But, situation can be very fluid when you are in negative interest rates. We'll have to see. We think that the inflation picture in Europe is looking far better than it is in the United States.
All right, thank you so much, Christine Aquino from our Markets Live team and Geraldine Sundstrom, Portfolio Manager for Asset Allocation Strategies at PIMCO. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. This hour, we speak to Sweden's Handelsbanken Chief Executive Carina Ackerstam and to BlackRock Vice Chair Philipp Hildebrand. Up next, we discuss more earnings news with Geraldine Sundstrom. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's take a look at some of the events that we're following today at 12 p.m. UK time. Well, it's Brazil CPI. After a small decline in December, 12-month inflation should tick up in January. Then, at 1 p.m., this is about the Bank of England. The chief economist, Hugh Pill, due to speak about UK monetary policy. Later this afternoon, we're also expecting some Russia CPI. One of the biggest inflation concerns has been coming in from Russia. It'll be interesting to see what that means, whether it continues to accelerate, keeping the central bank on course for further monetary tightening. And then at 5 p.m., we have, of course, the Fed. Loretta Mester from the Fed set to speak on policy at a seminar hosted by the European Economics and Financial Center. And finally, the big one in earnings in the U.S., Disney actually releasing quarterly numbers after the close of regular trading. So diplomatic efforts are continuing now across the globe to de-escalate tensions over Ukraine. Fresh from talks in both Moscow and Kiev, the French President Emmanuel Macron landed in Berlin to meet with German Chancellor Olaf Scholz, who had just returned from Washington, where he met with President Biden. So for more on all of this, we're joined by our European correspondent, Maria Tadeo in Brussels. And Maria, thank you so much for joining us. Scholz in D.C., back to Berlin, Macron, 4 cities in 24 hours. How much was actually achieved, though?
Well, this was a marathon day yesterday, Francine. And, to answer your question, I would put it in two ways. One is the optics of this. It's full diplomacy. The Europeans united half across the world to try to get a resolution on Ukraine. So when you ask diplomats how much was achieved, they tell you that in this instance, the optics really matter. They needed to show that Europe was serious about their security, and that meant really traveling half across the world to speak with their U.S. president, but also the Ukrainian president and Vladimir Putin. On the actual substance, that's where it gets a little bit more complicated. We know that Russia says we gave no assurances to anyone that we're going to pull back our troops. We also know that the exercise in Belarus that was due to come to an end. So that should not be seen perhaps as relief from that pressure that we've seen from Russia and the military troops. Having said that, when you speak to the European diplomats, they also tell you we're not seeing an escalation and we're not seeing a degradation of the situation. So when you put all of this in context, that's good enough for the time being.
Yeah, and then we heard from Chuck Schumacher, well, not Chuck Schumer, rather, not Mr. Schumacher, talking about sanctions and whether they would actually deter President Putin. Thank you so much, Maria Tadeo, there, our European correspondent in Brussels. Now, let's also have a look at what some of the companies, US-based and Premarket, are doing. Peloton, of course, has been in the news quite significantly, gaining some 3%. You can see Lyft down 4%, and then Microsoft, a little upside after it's said to be buying a cybersecurity company, one of the biggest acquisitions they had, and they bought two smaller companies last year. On the back of that news, a person familiar with the story telling Bloomberg that they're on the acquisitive path, gaining some 0.8%. Now, earnings season well underway, with lots of big names reporting this morning, including Equinor, GSK, ABN AMRO, and Maersk. So we're back with Geraldine Sundstrom, portfolio manager for asset allocation strategies at PIMCO. Geraldine, when you look at some of the things that we have been, looking at in earnings, I know a lot of it, of course, what happens to the balance sheet, but where do you find the most value in corporates right now?
I think one thing we need to all bear in mind is that the best day of economic growth are behind us, and that growth is going to slow down during 2022. All the more than central bank seem to be pretty resolute on hiking interest rates. So it's really a time to think about which are these areas that are going to be much less sensitive to GDP growth that will have sustainable growth going ahead. So we think that quality growth, actually, and companies with good balance sheet and cash flow are likely to do better in 2022, which I think, is a little bit different. We're moving away from some of the more cyclical, more value name into areas where we feel there will be more sustainable growth ahead.
Geraldine, we had a great chart actually looking at VIX and JP Morgan Asset Management, for example, saying this is, without a doubt, their bellwether. If it goes under a certain, or actually over a certain, amount of volatility in the 50-day moving average, then it's a buy signal. Are there any signals in the markets that you're looking at, flashing red at the moment?
Well, we think that until rates settle down, which means we need the inflation picture to settle down, is going to be difficult to make a resolute call for the end of volatility. There could be, a bad CPI print tomorrow, or there could be a good one. And what about the next month? And what about our average hourly earnings? So we think that the first few months of the year are going to be complicated. That said, this type of volatility is an opportunity. We don't think it's a massive risk. We don't think central banks are going to make a policy mistake. And that creates entry point for those companies with good balance sheet and sustainable growth ahead.
What do you do with commodities? I don't know whether there's something commodities that you want to buy right now. If you look at the current list of commodities in backwardation, we have natural gas, aluminium, copper, steel, rapeseed oil, soybeans. And if you look at aluminium, it's actually surging to the highest since 2008.
We think that the situation is going to improve. So any type of shortage, bottleneck, or price pressure are likely to improve as the year proceeds. So it's likely that we have seen the best days of a number of commodities, except for the ones that are going to be supported secularly, like lithium, like copper, like wood. We're sort of trying to differentiate here and really think that what we are seeing right here, right now, is somehow a bit of the remnants of 2021, some remnants of the reopening, massive liquidity amount. And this is a picture that we should put, in the back mirror and really look forward now.
Geraldine, overall, what do you do with some of the high yields? I know this has been one of the signals that the market is actually waiting for when looking at the more periphery bonds in Europe, but also treasuries.
Well, yes, we think it's a bit early still in that area, except for being very selective and bottoms up, which our credit analysts are doing. I feel like the intermediate at the moment, and maybe the area where you can get high yield and it's more attracting, is emerging market foreign exchange. We have there extremely active central banks that have been ahead of the major ones, which is very rare. And even in some, higher quality emerging markets, you can have liquid carry.
All right, interesting. Geraldine, thank you so much for joining us. Geraldine Sundstrom, their portfolio manager for asset allocation strategies at PIMCO. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. This hour, we also speak to the BlackRock Vice Chair, Philipp Hildebrand. Up next, though, we speak to Sweden's Handelsbanken Chief Executive, Carina Ackerstorm. Send in your questions on IB plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Handelsbanken has warned that it expects to take a hit of $131 million related to a new tax in Sweden targeting large credit institutions. Well, to talk about that, earnings, and of course what they're expecting in the future is the Chief Executive, Carina Ackerstorm. Thank you so much, Ms. Ackerstorm, for joining us. There's a lot of questions on actually some of the dividends, and your share price is under a little bit of pressure in today's trading session. Partly it's because shareholders are disappointed about the dividend that you're putting in place. Why not be more generous with shareholders given your capital position?
Okay, good morning and thank you for having me here. Yes, I think that the dividend, I think it shows quite well the balance that we see in terms of our ambition concerning growth in all our home markets, and together with when we look outside in the market and the geopolitical situation that we're in, but definitely mostly because we do have high growth ambition in all our home markets. So I think that is what it shows. Mm-hmm.
I know you've also said that exiting operations in Denmark and Finland are on track. Can you give us a little bit more of a timeline or your expectations there?
Yes. Exactly as I said, I can't say so much because we are just in the middle of that process, but it is definitely according to plan, and we have seen a very positive interest in both those home markets. So I can't say so much about it. We will definitely get back when we have more to say.
And I understand that you have to be closely guarded on it. But when you say on track, is it in terms of price or in terms of timeline?
In terms of time, in timeline.
Can you give me a sense of actually, some of the cost-cutting measures that you've put in place? I think you have a, $3 billion target. What will that impact?
Yes, we presented a plan in 2020, and we definitely follow that. We're definitely on track everywhere. So we have initiatives going on. We've had initiatives going on for 3 billion, and we have seen today 2 billion of them are not all in place. 1 million you can see in the result, and 1 billion will definitely come. And we continue to work with more initiatives when it comes to the Swedish operation, the central headquarters, and the process we have around extra. And we will see decreased costs in UK. So that is what we.
Yeah, and I want to ask you a little bit about the UK, but so once you've exited operation in Denmark and Finland, what kind of impact will that have on either shareholder buyback or distribution, or also the impact on your capital?
Yes, we will see. I mean, that is a decision that we will take when we have all in place. Again, I will say that. So when we look at the dividend moving forward, we will definitely get back on that when everything is in place. So that is, I'm sorry to say, but that is what I can say today.
and 100% understand, and of course we respect that. Give us a sense of what happens in the UK. So you become actually a lot more dependent and interlinked with the UK. How do you see the landscape for financial companies evolving in the UK given Brexit?
Yes, I mean, we do have a really good business in the UK, and we have spent quite some time to establish a UK bank. And with that said, that we do have a really good office. So when we meet customers today, we see that they are not that affected. I think that if you look at the UK economy, I think that gives us a lot of opportunities, both in the private business and the corporate business as well. So getting back to business again, I think that is, I'm really looking forward to that. So quite optimistic.
So I don't know whether you're optimistic also because there seems to be a global tightening monetary policy cycle getting underway globally. How much will that be of help to Handelsbanken?
Yes, I mean, in many terms, the business that we have, and in UK especially, and you can see that in all our homeworks for that matters, when we look into the kind of business we have with the private customer and with the financing for the corporate business, I think that gives us a good opportunity if we look what will happen in the environment around us.
Thank you so much for your time today. That was the Handelsbanken Chief Executive, Carina Ackerström. Now, up next, we speak with the BlackRock Vice Chair, Philipp Hildebrand. You can send in your questions on IB Plus TV Go. I know it'll be a robust conversation, of course, on what central banks are doing. Last time he was on, Mr. Hildebrand thought that they were looking at a policy mistake. Is that still the case? This is Bloomberg. Markets relief. Global stocks climb as sell-off in bonds abates on easing concern over monetary policy. Moscow undercuts Macron, saying no deal was reached with Vladimir Putin at a meeting Monday on Ukraine. We get the latest on that and stay with Bloomberg Surveillance Early Edition. Up next, we speak to the BlackRock Vice Chair, Philipp Hildebrand. We'll have questions on what's a bond bear market? Are we in one? What does a dollar decoupling again from Treasury yields also tell us about the market mood overall? You can send in your questions on IB Plus TV Go. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first thing is first, so let's check on the markets. And again, we saw a bit of support from the authorities over in China. That's given a nice little lift to Chinese stocks, and that's filtering through to Europe. Now, the million-dollar question is, of course, what happens with the bond sell-off? As that's cooling off a little bit, will it continue to be supportive for stocks? The stocks Europe 600 rising more than 1%, about 1.4% higher. Technology shares bouncing back. We also had a raft of generally positive earnings that reported that lift. Of course, that's lifting sentiments amongst, for example, some of the traders, but basic resources stocks underperforming. Iron ore on the way down. And then the one thing that I really like is actually dollar gauge. One of the million-dollar questions, again, that we try to ask a lot of our guests is actually what happens when there's this decorrelation or decoupling between the dollar and Treasury yields. The other thing we need to look out for, which is a really difficult question, is what part of the bond market concerns our guests the most. Let's also look at some U.S. pre-market share action. Now, Peloton, so much speculation about Peloton. We found out yesterday that they would not get rid of their instructors, the famous instructors that apparently are paid some $500,000 a year to do some of the class on Peloton. That stock gaining some 3.3%, a bit of pressure on Lyft, and then Microsoft. We're hearing about a possible acquisition of a cybersecurity company. Now, to talk about inflation, bonds, and everything in between, which means the dollar, periphery bonds, we're joined by Philipp Hildebrand. Now, before serving as vice chair of BlackRock since 2012, Philipp was chairman of the governing board of the Swiss National Bank. He served as the director for the Bank of International Settlements, as well as being the Swiss governor of the IMF and vice chair of the Financial Stability Board. But much more than that, he understands the linkage between markets, central banks, and inflation. So, Philipp, thank you so much for joining us. Now, last time you were on, you said, look, we're looking at a global tightening cycle, or at least the market is pricing in a global tightening cycle from central banks, and that is 100% a mistake because inflation is not a demand shock, it's coming from the supply side. You still hold that view?
Yes, absolutely. We're in a very different environment. It's a supply side driven inflation story. We have a restart, not a recovery. And we have new central banking monetary policy regimes that have led to a lot of questions around communication and around ultimate goals of central banks. So I think at every level we're in a kind of a new regime, and you can see this. The market is trying to find its way to what would eventually then happen throughout the whole cycle.
But Philipp, so if we talk about a policy mismatch, is this because central banks are communicating things wrong, or is it because they're panicking because they're seeing 5-6% inflation, which frankly is still staying on much longer than we thought last year?
I think there is a little bit of a race going on. Markets are pricing in new expectations. Central banks don't want to be seen to be not responding to this very high inflation, which is linked to the restart, and so they're responding. The rhetoric ratchets up, the market responds. So there's a bit of a race going on, a feedback loop. And I think eventually, things will settle. People will start to see through it. But at the moment, I would expect this to continue for a while, and we're going to see volatility. At the end of the day, I think we're going to see a muted full cycle of interest rate rises.
Would that be genius? Because actually, so you have central banks that at the moment seem quite hawkish. They end up being dovish, and so it's almost like they don't do much, but mission accomplished.
Well, we should think about why the cycle will be more muted, in my view, and I think that has to do with the nature of the inflation here.
Right.
Very few people really mentioned this is not an overheating economy. We're still growing below potential. So the idea here is these are inflation dynamics, very unpleasant, not acceptable in many ways, but they are driven by supply constraints, not by an overheating economy, and that will lead to a more muted cycle in the end. But until we get there, we're going to see a lot of volatility.
But I think a lot of economists are saying, look, I go to the supermarket and my tomatoes are whatever, €1.40 instead of €1. Even when the supply constraint eases, then that's not going to go back to 1.
I think that's right. I think we are going to see a higher inflation regime in a steady state than what we've seen in the last 20 years. And central banks will ultimately have to live with this higher inflation, because if they want to squeeze it all out and get back to what we had before in terms of the inflation rate, I think the cost to the real economy will be too great, because this is not driven by an overheating economy, but by supply constraints.
I also spoke to Jeff Curry of Goldman Sachs, and he was punchy. He said, look, I've never seen a market like this in my 30 years in the markets, and we're out of everything, right? You name it, and we're out of it. When do these supply concerns go back on track to something that's much more easy to live with?
I think the good news is I'm here today for the first time in almost 2 years. We're reopening. The quicker we can reopen the economies while paying attention to the health and safety concerns, I think the faster this will happen. My guess is we're not really going to see an easing on this before the third quarter, but I would be hopeful that if we can continue on the opening path, on the reopening path, that by the end of the year we're going to start to see some of these supply chains that will begin to adapt. Some of it will remain in place. Remember, we're going to have the transition to net zero. That's going to raise costs. That's going to create some of the same mismatches. We're going to have higher energy prices for a while. We're going to have a rebuilding of global supply chains generally to have them be more resilient. So some of these longer-term factors will persist, and that's why I think we're going to have to live with higher inflation going forward.
Philipp, who's getting it wrong? So out of the Fed, there's a lot of concerns that actually they're also, behind the curve or behind in the hiking cycle, because if you nip it in the bud, then you can kind of normalize a little bit. But between the Bank of England, the ECB, and the Fed, where does the policy mistake come from?
Well, I'm not going to comment on this. I think the confusion right now is, are we normalizing policy, which is what they're really doing right now, and that's perfectly acceptable. I think we no longer need very expansionary monetary policy given where we are on this powerful restart. Or are we kind of embarked on a massive tightening cycle, hitting the brakes? That's a big difference. And I think right now the market pivots back and forth from normalizing to hitting the brakes, and that's where the confusion comes from. So I think the more they can do to say, look, what we're doing right now is we're normalizing. That makes perfect sense. Nobody can argue with that. The question will then be, where does the full cycle lead us? Interestingly, if you look at the U.S., the full cycle hasn't, in terms of what the market is pricing in, it hasn't really changed. So I think this notion of at the end of the day, a muted cycle is still very much in play.
But is there a part of the bond market that actually worries you? I don't know whether it's, the pace at which treasuries are moving that's a concern. If we had, if we touch 2% in the 10-year, what happens?
Well, that's part of the tightening, of course, will come through the bond market. I think right now it's unpleasant because the regime has shifted. People getting used to it. You know, not long ago, central bankers were telling us we're not going to raise rates at all. That's clearly off the table. The normalization has begun. So the market is trying to find its way. And as we've seen in the peripheral bonds in Europe, that can be pretty unpleasant. So I think we're going to have this bout of volatility, perhaps for a while. But at the end of the day, I continue to believe firmly that this cycle will be muted relative to a normal monetary policy cycle.
I know you're a gentleman and actually, you know, didn't want to say on who's getting it the most wrong among central banks, but is it up to the market's job to get that nuance, or do communications in general with central banks need to change?
What I find troubling is that in some cases you have very little reference to the underlying cause of the inflation, and I think that's dangerous, right? So when you look at a problem, in this case higher inflation, you first look at what causes the problem. And by not saying anything, you sort of imply this is just a normal 70s type of overheating inflation dynamic, and it isn't. And so I think that the ones where I worry in terms of communication is where there's absolutely no reference to what actually is causing this higher inflation. I think that's the part where I'd be careful, because that can lead to misinterpretation by the market, and then you can get into a dynamic that becomes self-fulfilling, which could be very problematic.
Philipp, thanks so much. Philipp Hildebrand, their vice chair of BlackRock, stays with us, and we'll talk a little bit, well, a lot more actually about this inflation debate and maybe how some of the conversations surrounding central banks need to change. Up next, we continue our conversation with the BlackRock vice chair, Philipp Hildebrand. You can send in your questions as well on IB Plus TV Go. This is Bloomberg.
Economists have planned for a long time the fact that the inflation we're in would be probably longer term. I remain very optimistic for 2022 for Amundi. Our portfolio manager have anticipated this situation. They are actually diversifying our portfolio to make sure we keep the savings of our clients safe. And these rotations are important, both in emerging debt, for instance, or in value equities.
Well, that was the Amundi chief executive Valérie Baudson earlier speaking to Bloomberg exclusively on beating analysts' fourth quarter earnings estimates. Now we're back with Philipp Hildebrand for a robust conversation on bonds and, of course, for a robust conversation on inflation. He is vice chair at BlackRock. Philipp, you know, given the nuances that you were really hitting home on inflation, how central banks should look at it, how should investors position themselves on bonds? Should we chase, you know, lower duration or actually bet on convexity?
I think we continue to think that you want to be underweight bonds. This is a regime shift, and you have to remember we come from a kind of 30-year period of essentially bonds, you know, yields always, interest rates always going lower, a disinflationary, a very long disinflationary regime. I think that's over. So we have this very high, unusual, restart-driven, supply-driven inflation. But even once that sort of eases, we're going to be in a higher inflation regime. And so I think it's very important when you look at bonds to recognize this is a new regime. And the old regime has been around for a very long time. There are very few bond investors today active in the markets that remember anything different, the sort of previous regime. So that's why I think you want to be very careful here in this environment. And it's important to just recall higher inflation is going to be around for a while. We're going to have to learn to live with this. The cost of squeezing it back to what we had in the last 10, 20 years is going to be way too high, and central banks are going to recognize that. So the key is finding a way to live with higher inflation without leading to kind of an unanchoring of inflation expectations. That's really the art of what they're going to be faced with in the central bank.
So, I mean, and we also had a similar warning actually from the Goldman Sachs chief executive saying, look, we just don't have the muscle memory because this has been going on for so long, especially for the younger traders. I mean, I know we have, younger traders, older traders, chief executives of a certain vintage and not looking. I mean, what is your premise on what they should be looking out for? We're also seeing some decoupling, like funny moves, decoupling of dollar, for example, at treasuries. How should we read all of these signals?
I think that we're in between regimes. We're entering a new regime. The policy framework is not entirely clear. There's confusion as to, is it normalization, is it tightening? Central banks need to be very thoughtful as to how they communicate, put a clear frame out in terms of what they're doing, and recognize that, as you say, nobody has experienced this. You know, I was blessed to have known Paul Volcker as a mentor, but I wasn't in the markets when he raised interest rates at the time. So nobody has experienced this. None of us have seen a pandemic. We haven't really seen, very few of us were around in the, I think at BlackRock, Larry Fink is the only bond trader who was around at the time in this previous regime before we had this long disinflationary kind of period. So we have to recognize that all through these trading floors, all through these firms, a lot of people have, most people have never seen this. And that, of course, makes it all the more important for central banks to communicate clearly what they're trying to do and why they're doing it.
And there's no textbook, of course, because we've never seen anything like it.
No, we've never seen a restart. We've never seen a pandemic. We've never seen, almost never, inflation rates this high. We've never embarked on a net zero transition. So a lot of the things we're facing right now are entirely new. And so therefore we should not be surprised at volatility in the marketplace. Again, I think in the end, central banks will recognize this will be a muted cycle. Yeah. And they will begin to communicate accordingly, and then the market will settle down, and we'll have to live with some, a period of higher inflation.
But there's the kind of volatility that's good, healthy volatility, and then there's the kind that actually makes traders hide under their desks. What are we going to see this year?
I think right now, if you're a trader, this is interesting again, right after a very long time. I think the key here is that it doesn't spin out of control. And it can spin out of control in two ways. One is if the central banks kind of fire each other on to just get tougher and tougher and tougher, and eventually you throw out the baby with the bathwater. The other risk, of course, is that the market somehow starts to believe that inflation expectations have come unanchored, and we see kind of runaway inflation expectations, which would be a very bad outcome, because then the central bankers would have to hit the brakes very hard, and I think that's the thing that has to be avoided. The cost will be too high. So,
I don't know, are there indicators that we should look at? Are there, a lot of the economic forecasts have been wrong, certainly into 2022, on how inflation actually changes?
Well, one of the things you can look at is long-term inflation expectations. They actually, if you look at the U.S., they have remained reasonably stable. So there's no sign yet of kind of runaway inflation expectations at the moment, but it's a risk, but it's not really in the data. You can also look at what the market is pricing in as a full cycle. And interestingly, in the US, the full cycle hasn't really changed very much. We're still going to be, at the moment, the market is anticipating a full cycle of interest rate hikes that will be about half of what you would normally expect in a cycle. So those are things that you can look at in terms of seeing through the short-term volatility, look at longer-term indicators.
And then, of course, the market is largely ignoring geopolitics, right? Everything, a possible Ukrainian invasion, which I don't know whether it's a good or a bad thing. Should we start pricing in something, again, as just a buffer in case something goes wrong for the markets?
My experience over the years is it's very hard for markets to price in geopolitical risk until it happens. And I see this internally. We're spending a lot of time. We're lucky to have experts on this to give us daily updates. But if you're running a portfolio, it's very hard to price in something on the basis of a likelihood that you just don't know what it is. And so I think the market continues to be focused on it, intensely focused on it, but probably won't price anything in a significant way until it happens, or for that matter, doesn't happen.
Phil, we have a great question, actually. We have quite a lot of viewer questions, but this is a good one. As a great student of inflation, I think you'll enjoy this. So this person, thank you for writing in. We love hearing from our viewers, is writing in saying, why is there no discussion on the role of Fed FAIT, the flexible average inflation targeting adoption, and what the role of that was in creating the new CPI regime?
Well, I think it's a good question. As I alluded to earlier, the fact that central banks have adopted new policy frameworks, and the Fed was, of course, the first one, and the ECB came with a slightly more moderate new framework, I think has something to do with, it's one of the reasons why I believe inflation will settle at a higher level. And once you have a new framework, you can't kind of put it back in the bag that quickly. And so I think the listener is right. this is part of what has led to higher inflation expectations. And there are other reasons, as I mentioned, the transition to net zero, the rebuilding of global supply chains. These are all factors that have played in. But I do believe that the new frameworks have had something to do with raising inflation expectations.
Philipp, thank you so much. We have to get you back on and just answer viewer questions for like 3 hours. Philipp Hildebrand, the Vice Chair of BlackRock, in the studio. That was good. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine, and thank you. Toyota has stuck to its conservative profit forecast for the current fiscal year as it faces persistent COVID and chip-related disruptions. That is despite the world's top-selling car maker reporting an operating profit for the last 3 months of 2020 that easily beat analysts' estimates. Now, GlaxoSmithKline does expect profit to rise this year as it prepares to spin off its consumer health business, its biggest shake-up in more than 2 decades. The UK drug maker says earnings are expected to rise 12 to 14% in 2022 on an adjusted basis. And we'll be speaking to the chief executive of GlaxoSmithKline, Emma Walmsley. That's later today. Don't miss that interview at 12:30 p.m. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Coming up, today's big take, the first Super Bowl of the online betting era is upon us. And it's going to be wild. More on the NFL, online betting, and Byron Allen's bid for team ownership. That's all up next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now for today's Bloomberg Big Take, all about how the first Super Bowl of the online betting era is upon us. Well, online sports betting is being legalized in more and more U.S. states, and 100 million Americans can now legally bet on the Super Bowl. Commentators say sports will just never be the same. Well, joining us now to discuss all of this is our resident NFL lover, Bloomberg Quick Takes, Alex Webb. Alex, thank you so much for joining us. So first of all, how valuable is online sports betting for the NFL?
The NFL expects that it could be making $1 billion a year within 10 years. The sports betting market as a whole is worth something like $1.5 trillion. So even if the NFL is getting $1 billion, the pool in the US is likely to get a lot bigger.
So what are the societal risks, I guess, attached to it, and what happened in other countries, Alex?
Well, you do see that if of the number of people betting, they estimate that about 5% of those bettors are problem gamblers. And so if the number of people betting increases, inevitably the number of problem gamblers also increases. So if there are 100 million people able to bet in the US now, that could mean that maybe there are 5 or 6 million people who are problem gamblers. Now, that's clearly a big number. We've seen similar effects in, say, the UK, which had a massive liberalization of sports gambling advertising about 15 years ago. We saw the number of betting firms on soccer jerseys significantly increase, and the problem gambling also increased.
I know, and then Alex, big news, Byron Allen making a bid for the Denver Broncos.
Yes, it's a really interesting move. He would be the first African-American owner of an NFL franchise, coming a few years after the huge scandal surrounding Colin Kaepernick. One wonders whether having better representation in the ownership corridors might have changed the reaction to the Kaepernick affair. So if this deal happens, he's still putting together a bid, it would seem like a really exciting movement.
Alex, thanks so much. Alex Webb there from Bloomberg Quick Take joining us on the NFL. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kailey Leinz in New York, or Ann Edwards here in London. This is Bloomberg.
But come the second quarter, we're going to start to see just a pretty sizable growth scare.
We're going to have a very volatile but trendless market.
It's going to be a challenge, and investors should expect volatility as we navigate towards that.
I'm not just saying it's about defense. We can play a little bit of offense here, too.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Wednesday, February 9th. Our top stories today. Lyft hits a speed bump. It reports fewer than expected riders in the fourth quarter and says the fallout from Omicron will be felt this year too. After the bell, we'll get earnings from Uber and from Disney. Stretching an already worn thin supply chain. Automakers may soon feel the impact of that protest that's blocked traffic between Canada and Detroit. And it's the first Super Bowl of the online betting era. More than 100 million Americans now live in places where they can legally bet on Sunday's big game. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London. Matt Miller and Kailey Leinz are in New York. Kailey, good morning. I'll maybe leave the Super Bowl chat to you, Kailey. But in terms of the markets, we've got a real positive session on our hands here in Europe. It seems the earnings story offsetting concern around higher rates for now.
Yeah, it was a positive session in Asia as well. You know, I could talk about football all day long, but we also do have to talk about the markets because this is, after all, Bloomberg Television. That session in Asia, really across the board, we saw gains when it came to the major benchmarks. The MSCI Asia Pacific Index as a whole was up about 1.5%. A few outlier moves I wanted to point to, one being China, the CSI 300 up nearly 1%. Sentiment may be shored up by those state funds coming in to buy in order to stop some of the selling we have seen in equities. You also saw Hong Kong outperforming, and that was really a move led by technology. The Hang Seng Tech Index up more than 3.5%, and Alibaba was a big part of that. That stock up about 7%, gaining back what it lost yesterday after it made that filing with the SEC to register more shares when it came to those US ADRs. There was a lot of concern about maybe that meant SoftBank was going to start to sell some of its stakes. SoftBank out, though, overnight saying that it had nothing to do with it, so that maybe allays some of those concerns. Finally, I wanted to point to what's happening in Japan. The 10-year JGB yield is sitting right around 21 basis points. That is just off the highest going all the way back to January 2016. So we're talking 6 years, but the BOJ has decided not to alter its bond buying program. It seems that 25 basis points really is more the line in the sand. So that is something to watch from the overnight session, Matt.
Kailey, we have seen some decent gains. You know, yesterday on the S&P we were up. Today on futures we're up. Everything seems pretty chill, which is surprising considering the interest rate situation. We do see yields, though, coming back down. Right now, 190, 180. When Tom Keene talks, I listen. The surveillance co-creator sits behind me, came in this morning, logged onto his terminal. He said, wow, the VIX is below 21. And I think that's really what we want to watch today. Everything seems pretty unvolatile today, and that's why we see stocks rising and rates coming back down. Bitcoin, on the other hand, is off right now, $43,428. We have a couple of conflicting forecasts. JP Morgan says the fair value is actually more like $38,000. On the other hand, if you look at the charts, the technical analysts will tell you that after 6 days of gains, we're prepared for a breakout. Maybe today's drop changes that. Anna?
Yeah, absolutely. Matt, a lack of volatility and consistent moves to the upside across European equity markets. The map looking almost uniformly green this morning here for European stocks. Some of the things that have sold off most in the last couple of days on concerns around higher rates, gaining the most today. So we see the Italian market, for example, up by 1.9% today. So most sectors are in positive territory. I'll show you a couple of sector movers, though, that tell a bit of a story as to where we are at this point. Autos bouncing nicely today, up by 3.3%. Still a lot of concern about the supply chain issues within that sector and much more broadly. I know that is a topic we will return to later on in the program. But just to show that not everything is on the rise today, as we see those yields come down, see those rate expectations come down just a little bit, how long that lasts, we'll see. But as that is the dynamic of this morning's session here in Europe, we are seeing then some banks being sold off as a result. So the banking sector down by 0.1%. Amundi, a money manager here in Europe, the biggest money manager here in Europe, up by 4.4% today on their numbers. Inflows 4 times higher than had been expected for this particular business. A big part of the conversation over at Amundi is around passive funds. A.P. Moller-Maersk, a logistics giant, of course, now the world number 2, not the number 1, but still a big focus for us. 1.8% of the upside. It actually sold off in earlier trade because some of the guidance that they gave for the market, which was for the first time a glimpse of what they expect for 2022, could have been interpreted as a little bit conservative. They were talking about normalization of their markets in the second half, which might not be good for a business like Moller-Maersk, which has been riding high, of course, on the back of those high shipping rates, Kailey.
Yeah, and we are going to have more on shipping and logistics supply chain challenges throughout this hour. And as for what we're looking at throughout this day, this Wednesday, Federal Reserve Bank of Cleveland President Loretta Mester will be speaking at the European Economics and Financial Center event at 12 p.m. New York time. We'll also have EU foreign and health ministers meeting in Lyon, France for an aim of developing the bloc's health policy. And after the bell today, more earnings are coming. You have Disney at 4 p.m. New York time and then Uber after the bell, Matt.
All right, we'll be watching those closely. Let's dive deeper right now into earnings. So Bloomberg's Laura Wright out of London. Laura, what did we learn from Lyft yesterday?
Well, I heard you guys talking earlier, Matt, saying Lyft has hit a speed bump. Dan Ives, well-known tech analyst at Wedbush and friend of this show, he thinks Omicron and COVID cases are in the rearview mirror for Lyft. And in fact, we saw record average revenue per active rider topping $51. They were able to do this because pricing has been increased and also that driver shortage that analysts were pretty nervous about going into these results was less pronounced. In fact, Lyft, they're increasing drivers 34% year over year. Now, Uber is a different picture. It operates globally. And yes, there is the delivery business. The expectation from the street for Uber is that gross bookings will increase 50% year over year. Yes, comps were low. We can see Uber trading to the downside in pre-market this morning, but there is a notable headwind. The delivery space is far more competitive now. Companies like DoorDash in the States, basically, we are all too lazy or too busy to cook anymore.
I myself am not a cook, so I am definitely on that team. Let's look ahead. Besides Uber, what we're getting after the bell today is Disney as well. Are we expecting the same kind of headwinds for Disney Plus as we saw from Netflix a few weeks back?
You're right, Kailey. Netflix really did spook the market at the beginning of the month, and investor tolerance is low if we see misses on additional subscribers. Wells Fargo, they're forecasting 7 million additions this quarter. But bring this into the context. Disney Plus was only launched at the end of 2019, and the expectation on the street is that we're going to see 125 million subscribers by the end of today in total. So really phenomenal growth there. But Wells Fargo have a key line. They talk about large scale and also soul searching for the industry. The cadence of content, it's really expensive and we're getting bored of new content faster. It's the Tinder swindler today. What will Disney bring up tomorrow?
Thanks, Laura. Laura Wright with not at all boring content. Bloomberg's Laura Wright with the latest on the earnings stories to watch. Now, back to the logistics drama. In Canada, protests over vaccine mandates and COVID-19 restrictions have expanded across the country, threatening to spill over into the United States and sending a warning across the globe. Meanwhile, on the COVID front, in Hong Kong, they have reported record new cases, with many being linked to family gatherings during the Lunar New Year. Bernard Chan, a top advisor to Hong Kong leader Carrie Lam, spoke with Bloomberg earlier.
I don't think we can ever go into a full lockdown. We just can't do it in Hong Kong. We cannot have the same sort of lockdown you see in the mainland. That's just not possible in Hong Kong. But we will try to contain it.
Sam Fazeli, Bloomberg Intelligence Senior Pharmaceuticals Analyst, joins us now. It's interesting, your perspective of what a full lockdown is very much depends on where you first experienced it, perhaps, Sam. And what we're seeing in Hong Kong by European standards looks pretty intense, looks pretty locked down. Such are the limits on people's movement and ability to gather. What do you make of the way that China and Hong Kong is still trying to, okay, not COVID zero, but still very much focusing on keeping these case numbers down?
Yeah, hi, Anna. I think it's going to continue to be very difficult, especially with Omicron being the variant that's there. And if it's BA2, BA spot 2 subvariant, it's even worse because it spreads at about 15, 20, 30% better than the first Omicron, original, I wanted to call it. It's only 2 months, 3 months old. So it's going to be very difficult to keep this closed and lock down and stop it from transmitting unless they do a full people at home can't come out China style lockdown.
Do the rest of us, here we feel like the pandemic is coming to an end, need to continue wearing masks, Sam? Are we just virtue signaling? Does it really help anything?
Yeah, so look, I mean, it's not a difficult thing to do. I still wear one definitely when I go into crowded spaces, when I go into an airplane, when I'm at the airport, when everybody's crammed together before you get on the plane. But obviously, when you go into a restaurant or places like that, you can't really continue to keep wearing it. So I'm doing that. I'm fully expecting that I'll end up catching Omicron. It's impossible, I think, in my view, to avoid it unless you stay at home all the time.
All right, Bloomberg Intelligence's Sam Fazeli. I think a lot of us feel that way. Thank you so much for joining us. Now over to Washington. The House passed a 3-week government funding bill, sending the measure to the Senate ahead of a February 18th government shutdown deadline. Meanwhile, though, Congress is making less progress on foreign relations as lawmakers struggle to agree on a Russian sanctions bill over the Ukraine crisis. Anne-Marie Horder, Bloomberg Washington correspondent, joins us now from our D.C. bureau. So, Anne-Marie, Congress not really making any steps forward. Are we making steps forward on the diplomacy front?
Well, when it comes to the sanctions package, they'll tell you time is of the essence, but obviously some of that urgency is starting to fade. Similar on the diplomacy front, there were a number on a multifaceted front around the world of meetings between Emmanuel Macron and President Vladimir Putin, and then he went over to Kiev. And then he really swapped notes with Olaf Scholz, the Chancellor of Germany, together in Berlin, as well as with the leadership of Poland. So you could see there are a number of diplomatic meetings taking place. When it comes to the U.S. side, they obviously met with the Chancellor, Olaf Scholz, and Nord Stream 2 was really the topic of conversation here in Washington, D.C. And in Congress, that is also the centerpiece in terms of these negotiations and how they are struggling to reach an agreement on the sanctions package.
What do we know, Anne-Marie, about the state of Build Back Better, I guess 2.0?
Well, Senator Joe Manchin will tell you time and time again it's dead, but the president is obviously trying to get pieces of that agenda through. And today he's going to be talking about the climate provisions in that. More than $300 billion of that legislation would go to things like solar and wind energy, things you need massive utility companies to help foster. So he's having some of these CEOs from these companies join him at the White House. It's similar to what he did with executives last month from Microsoft, GM, and Ford. He's really looking out to corporate America to try to help boost some of these plans to get at least chunks of what he calls it and pieces of his Build Back Better across the finish line before the midterms.
All right, that clock is ticking down toward those midterm elections in November. Thank you so much to Bloomberg's Anne-Marie Horder. Now let's get back to the markets. Take a look at some stocks moving in pre-market trading here in the U.S. A big mover to the downside is New Relic. This is an application software company reported after the bell, forecasting a much wider loss than anticipated. And as a result, that stock is down a whopping 23% in early hours. For another application software company, though, it's a better story. Paycom actually topping expectations in its report. It is up about 8%. At this point. And another stock moving to the upside for potentially a third day is Peloton. It is up about 4% in early hours on this Wednesday after a record 25% gain on Tuesday and a 21% gain on Monday. Of course, the CEO, John Foley, stepping down, really stoking this optimism that potentially a sale will indeed be something that happens. So that stock is moving to the upside, now trading just under $39 a share, Anna.
Keeping track, Kailey, of the Peloton news flow feels like a full workout these days. Right, let's tell you what's coming up on this program. Ben Ritchie, Abrdn's head of European Equities, will join us. What does he make of the resilience we're seeing of European stocks and the strength of the European earnings season? And not to mention the global one. We will certainly get into that conversation. Plus, border blockage. How protests on the US-Canada border are stretching an already fragile auto and beyond supply chain. Plus, the NFL's big gamble. How legalized sports betting has changed the game. More on that and a few international learnings on the subject. This is Bloomberg.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on Bloomberg Radio and Bloomberg Television. I'm Matt Miller with Kailey Leinz here in New York. Anna Edwards with us out of London. We have been paying a lot of attention to the jump in yields lately. And the question in a lot of investors' minds is, what does this mean for the U.S. dollar? Does higher yield attract investors to the dollar, or do dollar investments really act as safe haven investments? And that's why we've seen such a big rise in the Bloomberg Dollar Index. This chart, for those of you listening on radio, shows that leverage funds have reached the most bullish level on the U.S. dollar since 2019, after a very bearish stance throughout the middle of the pandemic. Joining us now is Bloomberg's Kriti Gupta to discuss. And Kriti, does this mean maybe we're at the top here?
It very well might be. One of the big questions here is simply going to be, what purpose does the dollar serve, right? You hit it. Does the dollar serve as more of a safe haven, or does it serve as more of a bet on increased rate policy? I think in the kind of lead up to what you've seen in the Bloomberg Dollar Index and arguably equities as well, you have seen some of that hawkish kind of pivot from the Fed get priced in, especially as we consider 50 basis points on the curve. But on the other hand of it, to Matt's point, you do start to see the yield curve flatten a little bit, which once again brings up the fact that if the Fed is going to be this hawkish and this aggressive in their tightening policy, they're essentially slamming the brakes on the economy, and that's not good news for the dollar.
Well, you mentioned it all being priced in. Is it all priced in? Have we reached peak hawkishness, not just in the dollar, but in terms of what we're seeing in the Treasury market, for example?
I don't think we've reached peak hawkishness. And once again, it really comes down to that 50 basis point hike, right? We know there's going to be several rate hikes. We know there's calls for as many as 7 or 8 this year. It's kind of a crazy what the bond market is pricing in. But I don't think we've reached peak hawkishness, because it's not just the amount of rate hikes, it's the margin of the move, right? So the 50 basis points is going to be kind of your make or break trade, not just for the bond market, but for the dollar as well, because right now it's kind of a coin toss of whether it's going to be a 25 basis point hike or a 50 basis point hike.
Kriti, good morning. We're focused on these geographies distinctly, but we're also focused on the relative stories between them, aren't we? And certainly the relative interest rates narrative might be affected by that. And we've seen this pivot from the ECB recently to a more hawkish stance, certainly less dovish. A little bit of pushback, though, coming from ECB officials just in the last 24 hours. Bank of France, Villeroy, saying the market reaction to the ECB may have been too strong. Is that going to be in any way effective, or is that, that ship has sailed now? We've turned that corner and there's no going back?
Yeah, well, there was actually a really big spotlight on the cable rate just a few weeks ago. But now it seems like the spotlight has absolutely shifted to kind of euro dollars instead. Really, the point being that if the ECB, I should say, turns even more hawkish than the market is pricing, does that create just more kind of carry for the euro relative to what you're seeing right now priced into the market? The other piece of the equation is simply the outperformance of the rest of the world relative to the United States, because that isn't something that had really been proven true. That was the call, I should say, just about a year ago at the start of 2021, and it's a trade that didn't really come through fruition as we hit the end of 2021. But I think you're starting to see some of those funds actually target companies, target currencies, target even commodities outside of the United States. So I think, Anna, to your point, it absolutely is a relative trade, and a lot of the spotlight, once again, comes down to what's happening in Europe.
Getting back to the U.S. equities picture, we see some real calm coming into these markets. We were up yesterday. We're up in futures today. The VIX is down below 21. Is this about earnings? Is earnings season going all right?
I think it's more of a sigh of relief. Earnings are going okay, right? But I think it's a sigh of relief after really just the carnage that you saw in the first couple of weeks of the year. The idea that maybe we can take a little bit of a breather, reassess just a little bit, because a lot of portfolios, especially on a valuation basis, well, they're not as invested in the stock market as they were, say, January 1st, 2022, right? So I think one of the big questions now is they're looking at it more on a micro basis, which brings to your point earnings. But one of the big issues here is that the bar is set extremely high, because last earnings season, margins were the big picture, right? Everyone was beating on margins. Consumers were able to digest the price increases, I should say. And this time around, you actually have to beat on margins even further for the stock to actually get rewarded by investors. And that's coming at the same time as you see kind of a drawdown in that fiscal stimulus and consumer purchasing power.
Kriti, thanks very much. Bloomberg Markets correspondent Kriti Gupta with some of the latest themes we are following. If you want to get market analysis and check out the Market Live blog, MLIV Go, that is the function to use on your terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. Now let's get the first word news. And a New York judge has granted bail for 2 people charged with trying to launder billions of dollars worth of Bitcoin. The cryptocurrency was stolen in a 2016 hack of the Bitfinex currency exchange. Ela Lichtenstein and Heather Morgan were arrested yesterday. The government says it seized about $3.6 billion of cryptocurrency from the couple. BMW's choice to sell electric vehicles to the tens of millions watching Sunday's Super Bowl, that would be 1980s action film hero Arnold Schwarzenegger. In a commercial for the BMW's new plug-in, he says he plays a grumpy Zeus who is retired to Palm Springs with his wife Hera, played by Salma Hayek. Schwarzenegger tells Bloomberg Green, quote, "I would push alternative fuel vehicles from here to eternity." And media mogul Byron Allen is preparing an offer that would make him the first black majority owner of a National Football League team. Allen says he'll be making a bid for the Denver Broncos. Bloomberg's learned that the investor group led by Allen could pay as much as $4 billion for the team. And Anna, of course, I am personally invested in this story as a Denver Broncos fan, but really this could be a big deal for the NFL that has been plagued by a string of racially oriented issues, from Colin Kaepernick kneeling during the national anthem in 2016 to recently allegations from Brian Flores, the former coach of the Miami Dolphins, about racial discrimination in the NFL, because the players predominantly in the league are black, and it is not represented at the coaching level or at the management level or at the ownership level to this point.
Right, and this story could change that. Yeah, an interesting new story for the NFL to tell then if this comes to pass. We'll get back to the markets shortly. Ben Ritchie, Abrdn head of European Equities, joins us. Strength in Europe today. We'll talk about that next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Here is what you need to know. Shares of Lyft are lower. The company reported fewer riders than expected in the fourth quarter as Omicron hurt travel. But the riders that did take Lyft generated higher revenue due to higher fares. Meanwhile, the company has been dealing with a persistent shortage of drivers. After the bell, we will get earnings from rival Uber and Disney. Protesters blocking traffic between Canada and Detroit are further stretching an auto supply chain that's already worn thin. Automakers indicate there's been little impact so far, but the situation could get worse within days. The demonstrators are showing their opposition to vaccine rules. And it is the first Super Bowl of the online betting era. More than 100 million Americans now live in places where they can legally bet on Sunday's big game. After decades of opposing gambling, the National Football League is now all in. The NFL says it's taken strong measures to prevent any corruption. More on that story shortly. That is a look at what you need to know this morning. Matt, what are you looking at ahead of the market open?
I'm looking at markets that are relatively calm this morning, Anna. We have gains on S&P futures right now after we rose in the cash trade yesterday, and the VIX is holding down around 20. So after that big bond market jump that we saw in yields, things are coming back to normal to some extent. You can see the 10-year yield right now at 192.34. Yesterday at one point we were at 197. So we were really getting up close to that 2% level, and it looks like we're going the other way. Bitcoin right now down 1.25% after 6 days of gains. Today would be a seventh. 43,676. As I've said, there's a couple of opposing views in the market. Obviously, that's always the case. But we hear JP Morgan saying fair value should be $38,000, although they do say long-term $150. The charts tell us we may be ready for a breakout, and obviously Bitcoin is a very technical asset. Kailey, what are you seeing in terms of pre-market movers?
Well, it really all comes down to earnings when we look at the movers before the bell this morning. Of course, you had Lyft reporting after the bell yesterday. Its riders actually missed expectations, the Omicron variant having a big impact on people's desire to use ride sharing. If there is some positive news, though, they are making more with the riders that they do have. That revenue metric is increasing, so that is a bright side to the equation. But nonetheless, the shares are moving lower in early hours, down the better part of 4% when it comes to Lyft, and also dragging a bit on Uber, which is down about 0.25%. It, of course, will be reporting after the bell today, so we'll see what the read-through is. But, of course, Uber has the extra insulation of the Uber Eats business, that food delivery business. It's not just about ride sharing for that company in particular. A much more positive story, though, when it comes to Enphase Energy. This is a solar player reported after the bell yesterday. Its revenue forecast handily exceeding expectations. As a result, that stock is up about 18% in early hours, Anna, and it's taking a lot of other solar-related stocks up with it as well.
Yeah, that's an interesting development, one to watch there, Kailey. Let me tell you what's going on here in Europe. Just as Matt was saying, a fairly buoyant picture for European equities in general, and just one of those sectors that has been much beaten up of late and now moves to the upside. The auto sector up by 3.2% or so. And in general today, we're seeing some of those areas, some of those geographies that have sold off in recent days as we've been concerned about sovereign spreads or higher interest rates more broadly, such as the Italian market. That's where we're seeing some of the bigger bounce coming today. Not all sectors like this pullback in rates, if that's the right phrase for it. We've seen, of course, higher rates and now rates giving us a pause. And that doesn't go down too well with the banking sector because banking stocks have done quite well out of those higher rates conversations that we've been having in recent days. So the banking sector down 0.1%. Amundi, the biggest money manager here in Europe, that stock up by 4.7%. Inflows really outperforming 4 times what had been expected by analysts. So that's the story there. AP Moller-Maersk on the logistics side up by 1.7%. Just how conservative was the guidance from this business? They talk about normalization in the second half of the year. So an interesting one to watch, of course. Share buybacks, return of cash to shareholder, balance sheet efficiency, all part of the conversation when it comes to logistics. Kailey.
And we'll be talking more about logistics shortly. But first, Anna, we have to talk more about these markets. This is a question we raised with Kriti Gupta a bit earlier in the hour. How much hawkishness from central banks is already priced in? Can the moves we have seen go even further, or have we seen the worst of it in terms of the equity volatility and the global bond sell-off? Joining us now is Ben Ritchie, head of European Equities at Abrdn. Ben, do you think the worst is over? Are we comfortable with more hawkish central banks now?
Well, I think we're certainly seeing a level of a rotation within markets that we're unlikely to see repeat. I mean, I think when you look at in January, I think you saw the 3rd biggest annual rotation of value against growth in just 1 month. So it was a phenomenal strength of rotation. I don't think we're going to see that repeat itself. But again, I think it's likely as we're operating in an environment of monetary tightening that we're going to continue to see volatile markets ahead of us, I would have thought.
Ben, good morning. Does your stance on equities, does it very much depend on the speed of the move that we see in treasuries and other interest rate dynamics globally? Is that going to be what's in the driving seat?
Absolutely. I think it's all about those expectations. And we saw a big adjustment during January. And then now I think markets are waiting to see what's next. And I guess there are counterposing views, aren't there? Yes, there's a more hawkish environment for central banks. But on the other hand, perhaps the growth data might also be looking to weaken. Perhaps central bankers may have thought they've talk things up too much. So we'll have to see how those two things are playing against each other. But I don't think we're going to see quite the sharpness again during 2022 that we saw in January.
Ben, are you surprised by just how long some of the supply chain issues are lingering and hanging around? We're going to talk about this a little more in the next part of the programme. But I just wanted to get your perspective because it's still a feature of this earnings season. And maybe some people thought it would have gone away by now. And we're still talking to executives who are saying, look, it's going to normalise in the second half. And that seems to be a sort of default answer.
I think second half normally means we don't know when, but we hope it'll happen at some point. And I think that's kind of where we are. I mean, we were talking about this at the end of 2020, and we're still talking about it now. And I guess it's that thing where you've had that sharp demand rebound, particularly in goods, but maybe we'll also see that coming through in services against already stretched supply lines that are suffering from disruption. That's just been very difficult to fix. Hopefully we will start to see some of that ameliorate. You would have thought so, but you're also trying to catch up with where you were. So it's not just getting back to where we were, it's also having to put in additional capacity as well.
For the last few sessions, Ben, we've all been kind of freaking out a little bit about rising rates and the widening spreads that we're seeing in Europe. Does that bother you think equities at all? Doesn't seem to have had much of an effect.
Well, I think it's an incredibly interesting dynamic, Matt, because at the moment you've got this sort of rise in interest rates, in longer-term bond yields, in short-term yield expectations as well, which is positive for certain sectors. We talked about banks earlier, energy, you've seen commodities moving up. But equally, the implications of that and what that might mean for the real economy as we move through this year are not perhaps that positive. So you've got this real balance of companies that are benefiting from some of these nearer term trends, but then also trying to keep an eye on what might happen as we move through the year, and perhaps the environment may be getting more difficult. So I think it's quite a tough environment for investors to balance both what might be driving near-term earnings, but what might also be bringing some risk down the line. And I think that's a tricky combination to look at right now.
Does it hurt more small and mid-cap companies when you see rates rise? They have more difficulty maybe rolling over debt?
Well, I think generally speaking, valuations there are probably less demanding, and as a result, maybe there's a little bit less pressure from a sort of valuation perspective with rates rising for smaller companies. But if we do move into a period of more risk-off environment, then generally speaking, you do tend to see smaller companies underperform in that environment. We haven't quite sort of got into that picture yet, Matt, but that would be, I think, a scenario where we need to move into an environment where people are more cautious on the overall macro outlook.
Ben, thanks very much. Thanks for your time. Thanks for coming in. Ben Ritchie, head of European Equities at Abrdn, with his thoughts on the outlook for equities ahead. Coming up on this program, then, I mentioned that we're going to talk about supply chain. Kailey's been talking about this morning as well. Blockage at the border, how protests in Canada are stretching an already fragile auto supply chain. And we'll talk global shipping rates and the global conversation as well. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Disney CEO Bob Chapek. That's at 5:30 p.m. in New York, 10:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. Let's talk logistics. Maersk is buying Pilot Freight Services for $1.68 billion. The shipping giant is growing on land in pursuit of higher margins. We spoke to the CEO, Søren Skou, earlier today.
We have built in the last few years quite an attractive and profitable growth engine in landside logistics, basically selling logistics products to our ocean clients, and we're building out the capabilities there, particularly when it comes to fulfillment, where a lot of our clients, almost all of our clients that sell to consumers today, require both a logistics chain that can help them keep their brick and mortar stores stocked, but also an omni-channel strategy that can help them serve the consumer directly. And we're putting together our logistics offering so we can do both for our customers. Pilot Freight Services gives us further capabilities in that space, and that's why we're acquiring the company. The way we will pay for it, if you will, is to supercharge the growth of the company by selling the services to 10,000s of Maersk customers.
How is inflation in terms of wages and the tight labor market, how is that affecting your cost as a company?
Inflation is certainly also reflecting or impacting our business, and it will certainly do so in 2022. For once, I mean, we are impacted by the oil price. Clearly, we spent last year around $5 billion on fuel. So when the fuel goes up, it's a big ticket item. Our cost for port handling is clearly going up. The same goes for labor in warehouses and labor, in ports, trucking, and so on. So on a wide basis, we are seeing cost go up, and it will be with us for a while. Particularly the cost that is associated with ship leasing, where we have had to pay much higher prices for container ships that we lease, and that will stay with us for quite a while.
That was the CEO of the shipping giant Maersk speaking to us earlier today. And Matt, really interesting conversation there. The share price actually wobbled at the start of trade, now up a couple of percent, as the market was not sure what to make of the guidance, which maybe seemed a little bit conservative. But when you speak to the company, they're saying they need to assume normalization of things in the second half of the year. But that doesn't involve the prices they'll be able to command, because they've signed these long-term contracts, which mean that some of the higher prices we've seen recently, they keep benefiting from. You know, this is a sector that's done so so well out of the disruption.
Well, and it's always better to underpromise and overdeliver, isn't it? The shipping margins have been fantastic for Soren's Go, and the shipping issues have been a real problem for producers. If we look at what's going on in Canada, for example, around Ottawa, where protesters over vaccine mandates and COVID-19 restrictions are spreading, it is horrendous for car makers. Truck blockades have halted commercial traffic at the critical crossing from Alberta into Detroit. Let's get more with Theo Argyris, Bloomberg's Ottawa bureau chief. So, Theo, I don't know much about this bridge, but what I do know is that a lot of the U.S. car makers rely on Canadian production for everything from small parts to entire vehicles, and this can really cause problems for the supply chain.
That's right, Matt. Essentially, this bridge connects Detroit with Canada, and there is the auto sector has a number of facilities in Canada, and there's a lot of trade going on between the auto sector in Detroit with the auto sector in Canada over this bridge. About $100 million per day of auto parts and automobiles cross over this bridge every single day. So it's a critical bit of infrastructure for the auto sector and for trade between the two countries in general. About $150 billion worth of commercial goods gets transported over this bridge every year. And it's just this escalation of these trucker protests that we've seen in Ottawa now for almost 2 weeks, and we've also seen a border crossing between in Alberta, which is Western Canada, that is also being blockaded by truckers who are protesting vaccine mandates that essentially force them to get vaccinated if they want to drive trucks over the Canada-U.S. border.
Yeah, and so good morning, Theo. Is there any sense that any of this is improving at all, or at the margin of things worsening?
Well, I was just looking, just before getting on here, I was looking at the Canadian Border Services Agency website, which essentially gives you wait times for bridge crossings. The Ambassador Bridge, that critical bridge we were just talking about, is still closed for commercial traffic. The commercial traffic, the trucks are being redirected about 65 miles north of Detroit. There's another bridge there that is passable, but there is a 4-hour delay to get over that bridge right now. So apparently, as of 5 o'clock this morning, there are still major disruptions on border crossings between Canada and the U.S. right now.
Okay, so let's talk about the political pressure this puts on Justin Trudeau. I saw a member of his own party yesterday publicly criticizing him for this harsh stance on vaccine mandates. What are the implications? Could we see a reversal from the Prime Minister?
I mean, it's very difficult to see a graceful exit from this because Trudeau has taken a very hard stance on vaccine mandates. Essentially, he ran an election on obligatory vaccines in September, which he won. And so, I mean, his position has been very hard, and so are the truckers. They are demanding essentially the elimination of these of all of the vaccine mandates, including mandates from regional and local authorities as well. So, given that Trudeau ran an election on this, it's very hard to see how we actually get a resolution here. But you're right. I mean, you are starting to see a little bit of criticism from within his own party that maybe his position on vaccines now is counterproductive, right. and maybe there should be some type of pathway towards kind of loosening restrictions.
Well, Theo, I mean, it begs the question, what's the COVID situation like there? I mean, is COVID spreading like wildfire through these protests? Are they all giving it to each other? Is Ottawa right now in kind of an emergency lockdown situation? Is everyone getting COVID, or could they just do away with the vaccine mandates at this point?
Well, I mean, we've had sort of the same sort of wave, Omicron wave, as other countries have had, including the U.S. It's just that in Canada, the restrictions around COVID are just much more draconian, really. I mean, in Quebec, just a few weeks ago, there were curfews. Canadian authorities have responded to COVID now for 2 years with much more restrictive, lockdowns than the U.S. And that's just the path that they've taken. Essentially, the difference between Canada and the U.S. Is that Canada's death rate has been a lot lower than the U.S. death rate. So Canadians have chosen a lower death rate, the path of lower death rate, but the cost of that has been much more severe restrictions. But you're seeing quite a bit of a pushback now, given that a lot of other countries are starting to loosen up a bit.
All right. Thank you so much to Theo Argydes, Bloomberg's Ottawa bureau chief. Appreciate you waking up early for us this morning. And coming up later today, we're going to continue the conversation around supply chains, the impact of COVID-19 with Port of Los Angeles Executive Director Gene Soroka. That's at 10:30 a.m. in New York, 3:30 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kailey Leinz in New York and Anna Edwards in London. It is that time of the program when we commune with our creator. Tom Keene joins us, co-anchor of Bloomberg Surveillance, with a look at wages, which has been, a really hot topic, Tom, because, and it's been very political, right? Because Biden at one point claimed basically that he was able to boost wages faster than inflation.
Yeah.
It's a little iffy depending on which chart you look at.
One of the best hires Bloomberg ever did was the heartthrob Matt Boesler. He walked in the door and everybody quaked Matt Miller, and he does great in economics. His first job was covering the New York Fed. And he has a really profound statement, which is perfectly seen in this chart. Average hourly earnings weekly adjusted for inflation. And what Boesler's saying, I'll let you pronounce it, Matt, is get over it. Real wages had a huge surge off the pandemic. And yes, we've come down to real weekly paychecks that are ugly, but we must forget there was a real wage boost along the way.
Yeah, Matt Boesler. I think Boesler is the way he pronounces it.
Thank you.
Okay, we'll copy you. We'll copy you, Matt. Yeah, it's a really interesting one. And one of the things we watch every time we get inflation data, Tom, and we've often seen economists getting things wrong on inflation in that they've been under forecasting where inflation will get to. And one of the explanations we hear is it's just really difficult to say what people will do with all those accumulated paychecks, all that money that sits in a very aggregate sense on people's and companies' balance sheets. Estimating how much of that they will then plow back into the economy has been really difficult.
The answer is we believe less. The savings debate, Anna, is legitimate, and it's really contentious. I don't have a strong opinion on that. We just talk to the experts that we can. Some saying savings is worn out. People have worn out. Jim Glassman at JP Morgan suggesting people have to get back to work. But the savings debate is there. What I would say is on the institutional side, we've got money up to the eyeballs.
All right, valuable insight as always. Tom Keene, co-anchor of Bloomberg Surveillance. Thank you. And just a trick for you, think Boesler, like bow ties. I think that'll maybe work out. Now look at what else we're watching today. I am watching the Big Take story out today. You can find it on NI Big Take as well as online because it focuses on the Super Bowl and the NFL, two of my favorite things, Matt Miller. I know you're watching this too, and just the history of sports betting within the league, how it was kind of reluctant to get into the gambling sphere early on, but now it has fully embraced it to the point where you're seeing some of these online betting companies sponsoring lounges and stadiums. You have owners now investing in businesses like DraftKings. You can even bet on whether Joey B is going to complete his first pass in the game on Sunday. So it's definitely something to watch.
You can bet on the color of Gatorade that is dumped on the coach after the game. You can bet on everything. I grew up in London with a flat full of bros who were betting on cricket and rugby all day long, totally addicted. And this is, of course, what the gambling companies want. The question is this good for the NFL? Is it possible to keep corruption out of the league? And it's not just the NFL, right? It's leagues like the NCAA, which have had issues with corruption in the past. So I guess it's concerning. On the other hand, I really want to place bets.
You do want to place bets. I mean, 15 years ago, we liberalised things here in the UK when it comes to betting, certainly in football or in soccer. And so we have that experience to go on. And actually, we're looking to the UK government to actually cut back the power of some of these businesses to sponsor and to put money into the game, certainly on shirt sponsorship. That's a big focus here in terms of English football, for what it's worth. Anyway, we hope it goes well for the NFL. This is Bloomberg.